Alright, let's talk about implied volatility and how it affects option credit spreads in the stock market. We'll break it down into simple terms and explain how you can potentially use this knowledge to your advantage. Implied volatility, or IV, is a way to estimate how much the price of a stock or index might change in the future. It's calculated from the prices of options contracts and is shown as a yearly percentage. There's an interesting relationship between stock prices and implied volatility. They usually move in opposite directions. When stock prices drop, IV tends to increase. And when stock prices go up, IV usually goes down. This is because people get more nervous when the market is going down, which leads to higher option prices and, as a result, higher IV. On the other hand, when the market is doing well, investors are more optimistic, leading to lower option prices and lower IV. In options trading, IV is crucial for figuring out the price of an option. Options with higher IV are more expensive because they suggest that the stock or index they're based on might have more significant price swings in the future. This extra uncertainty makes the options more valuable to traders since they could potentially generate more profit or act as a better hedge against price movements. Now, let's talk about option credit spreads and how IV plays a role in their pricing. An option credit spread is a strategy where you sell one option and buy another option with a different strike price but the same expiration date. The goal is to receive a credit when you open the position and keep as much of that credit as possible when the options expire. When IV is high, option premiums become more expensive because the market expects more significant price swings for the stock or index. This is when credit spreads can become more attractive. By selling an option with high IV, you collect a higher premium, which increases the credit received when opening the position. At the same time, you also buy another option as a hedge, which will also have a higher premium due to the high IV. However, since the option you buy is further out of the money, its premium will be lower than the one you sell, allowing you to keep the net credit. As IV decreases after you've opened a credit spread, the value of both options in the spread will generally decrease. Since you sold the option with a higher premium and bought the one with a lower premium, the decline in value is more significant for the option you sold. This works in your favor because, when the options expire or when you close the position, you can buy back the sold option for a lower price than what you initially received as credit. The lower the options prices become, the more of the initial credit you can keep as profit. It's essential to note that trading credit spreads when IV is high can also come with increased risk, as the larger expected price swings could lead the stock or index's price to move against your position. However, if you have a well-researched strategy and manage your risk carefully, trading credit spreads in a high IV environment can potentially result in higher returns. When things turn out to be unfavorable to you, it's crucial to consider whether it's better to take a loss early to prevent further loss or wait for the situation to revert back to your favor. Striking a fine balance between the two is vital for success in option credit spread trading. To predict winning probability and expected price trends, one of the strategy I use is to leverage past trading data using linear regression and simple machine learning. Look into similar patterns from key data points in the past, such as days to expire, volatility index at the time, percent delta to strike prices, and many other factors, to essentially predict winning probability, and where stock price upon expiration would land, relative to the strike prices. This kind of data-driven, objective approach is crucial in making systematic trade decisions with high probability winning outcome. In summary, implied volatility is an essential concept in options trading, especially when dealing with credit spreads. Understanding how IV affects option pricing and being aware of the risks involved in trading credit spreads during high IV can potentially lead to higher returns. Remember to carefully manage risk, strike a balance between taking losses early or waiting for situations to improve, and consider using past data to inform your trading decisions. By keeping these factors in mind, you can make more informed choices in your options trading strategy.